I'm honored to introduce Tom Jacobson and John Del Vecchio, who will be presenting their book, What's Behind the Numbers. I know these guys as analysts in the Motley Fool service of financial analysis. I have made and saved substantial money by following their advice, so I cannot fail to recommend that you guys do the same. John?
Thank you. Thanks.
Our book title should be pretty obvious. And then this is who we are.
I'm John Del Vecchio. I'm a chartered financial analyst. Had the pleasure of working with Howard Schilit, who's a famed forensic accountant and very famous for finding fraudulent companies that are publicly traded. Worked for David Tice, who's the manager of the Prudent Bear Fund, which is the largest mutual fund in the space that shorts stocks, which is betting against them. I'm the co-manager and the co-founder of the Active Bear ETF, which is the largest actively traded equity ETF in the market right now. Work for the Motley Fool under the Alpha brand, which is a newsletter that's long and short at the same time. It's kind of a hedge fund. And according to Tom, I'm a snappy dresser. I don't write this stuff, I just read it. So that's
well, if it weren't for John and my non-business partner, I wouldn't even know what to do.
Be all dapper in an Armani suit.
I have a 2000 Men's Warehouse suit that I got that's 14 years old, 13 years old. John wouldn't let me go out with that. Former lawyer, graduate of Cornell and the University of Chicago Law School. The reason that I mention that is not to show off pedigrees, but more to show you that pedigrees are irrelevant in investing. All you need to do is math. You don't need calculus, which is good since that was where I kind of ended my math career. And some of the allegedly most pedigreed smart people don't do well in investing. I think the life of experience, learning from mistakes, is more valuable. However, that's very valuable when you get in front of a room of lawyers who are really, really, really a tough crowd. My father got me investing at 12, said, here's $100, buy something. I bought Ford instead of Wrigley. Big mistake. I've been a high school teacher in Venezuela, Kenya, all around, a lawyer and entrepreneur, and today I'm the portfolio manager of Motley Fool Special Ops. What John will talk about is what he does. What I talk about is what I do, and we both believe that together this is the way to deal with risk. We're primarily risk managers. We wrote this because we watched and lived through painful losses through 2000, 2002. John saw this coming, and it wasn't so painful for him. For me, it was extraordinarily painful on the long side, and it turned me to value investing. And we all know about the zeal of the newly converted. I embraced value with the zeal of the newly converted. And catastrophic losses in 08, 09, which really set back the investing clock for many people, and the older that they are, or were at the time, the more difficult it's been. We would like this not to happen to them or to you. 3 parts today: what doesn't work, what works, and then John will give his current market view, which is that there are clouds ahead. What doesn't work? Dollar cost averaging is familiar, I think, to most of you. Google has a 401k plan, I assume, being a very forward-thinking company. And so if you participate in every paycheck, money comes out, and you direct its investment in options that the 401k provider offers. Primarily mutual funds? Yeah. You can't buy individual stocks?
No, you can. Yes, you can.
You can?
It's Vanguard.
Good.
Vanguard
Anything in Vanguard brokerage.
Excellent, excellent. So you can get into trouble. No, but I mean, that's a very good option, and particularly for people who spend a lot of time working on this. The problem with dollar cost averaging is that what happens is that people stop making their payroll deductions, or they move them to cash, and they lose the benefits of the automatic averaging that you get. The problem with investing for many people, even in indexes, is that you inadvertently market time unless you're doing it mechanically every single pay period, averaging out your purchase price, right? The problem is it requires discipline. There was a great study that Morningstar did where they looked at the returns of CGM focus funds, Ken Huebner, who Peter Lynch called one of the greatest investors of all time. Huebner's had incredible results, but has high volatility, right? Up and down, high beta to the averages. Morningstar found that while Huebner did extraordinarily well, his investors did not. They would sell after a bad year, and then they would buy after a good year, selling low and buying high. This actually is what most people do. The other thing that dollar cost averaging requires is a steady income cycle, and I had the pleasure of speaking the other night to a group of people, a number of whom have been laid off by HP, and they were actually, I shouldn't say this, they were actually very happy to be gone, but they had they were. And they had a lot of money. They got big lump sums of payouts and so on. They said, well, Tom, I can't dollar cost average. What do I do? So it just doesn't fit most people. And psychologically, we know from behavioral finance, this is very difficult for people.
This is one of my favorite charts. This is about asset allocation and why it doesn't work. This is the American Association of Individual Investors, which is most of us in the room here today. This shows the 3 time periods of the highest cash position, the lowest cash position, and then today. And we'll get more into the kind of the market view at the end of the presentation, but wanted to highlight the extremes that occur. The highest cash position ever was in March of 2009 at 45%. If you remember, that's the exact low of the market. So at this point in time, everybody was slashing their wrists and running under hot water when they should have been buying stock. And they had 14% in bonds and just 41% in equities. And now we've been in a massive 44-month move off the bottom where equities have well more than doubled. And if you've picked individual stocks, in many cases they're up 1,000% or more. The lowest cash position of all time was March of 1998. And for those of you old enough to remember the internet boom that ultimately crashed, that was right around the time when it was getting into that
I remember that.
Yeah, that was pretty painful. So everyone was fully invested here. At this time frame, 74% was held in stocks and just 15% in bonds. Today, we're at 18.8% cash, and there's a notion that there's a lot of cash on the sidelines in the marketplace, and that's going to drive the stock market higher. I would argue that that's not going to occur. You have to remember that this was during a once-in-a-generation bubble period that occurs about once every 25 years. It takes a long time to work off of that until someone's stupid enough to create the next big bubble. And we're at 18.8, and this was 11. So if you cut it in half, maybe there's 4% more that could go into equities. But we're also see a lot more into bonds, 15% bonds here, and there's 21% bonds here. Why is that? It's because demographics have changed. The investors in 1998 have gotten a lot older. It's 14 years later. My mother, for instance, was a baby boomer. Her highest earning years were from 1980 to 1999. She worked for Bristol Myers Squibb. She had a 401k plan, no college education. She had stock options, cash bonuses, health care. Most of that stuff has gone away now. She was fortunate enough to retire in 1999 and kind of rode off in the sunset. But for the most part, that's not really happening today for a lot of people. So I would argue that this cash position is probably about as low as it's going to get, maybe just a couple percent lower. And that's why you need to be defensive in your portfolio. But these individual investors usually are horrible at allocating capital. And that's really been the case over the last 30 or 40 years.
And even the big asset allocators, have brokers who have their clients in programs where they'll have more options, precious metals and so on. 2008 killed them.
And we'll get into that as well. Active investment managers who are quote unquote professionals are just as bad as individuals, and I'll show you an even worse chart when we get to that. So.
Right. What investors want is safety. They want to buy and forget, and they want inflation protection. What they get is volatility, which scares them into selling low and buying high. They get buy, forget, and then they lose, and inflation is beyond their control.
Today's winners are tomorrow's losers. So growth loses over time. And the stocks from one generation that are leaders are generally not the leaders of the next. So imagine that we were here in 1979, and I told you that we were talking about Eastman Kodak and Polaroid and companies like that were nifty 50 stocks. And I said in 30 years, they're either going to be bankrupt or bailed out by the government or cut their dividends. That would sound like blasphemy, but that's exactly what happened. Roll forward to the internet boom. You've got Microsoft, Intel, Cisco, Dell, Hewlett Packard. Those were kind of the big horsemen of the internet and the PC cycle. That's pretty much been dead money for the last 14 years. So if you're a wealth advisor and you've got your clients in those stocks, you probably got fired. The bull leaders lose 80% in the next cycle. That's research by William O'Neill. He's the publisher of Investors Business Daily and has been investing in stocks for about 50 years. And so you can't just buy a stock and forget about it. Times change. The environment changes, the economy changes, technology changes, and so buying for the long term is actually very dangerous unless you're just buying an index fund and holding that over time period. So what we're going to tell you to do or show you how to do is avoid the losers before they become a big torpedo in your portfolio.
Peter Lynch, whatever respect we may have for his books, did a great deal of damage with the buy what you know, buy and hold, because he was operating in the biggest bull market that we've ever known and probably will ever know, when admittedly he had very good results, but he had the wind at his back. I would be really surprised if we ever see another bull market of the length that we had during 82 to
1982 to 2001.
Yeah.
We could
right.
We could argue
about that, or till today. Now, what I'd like to point out here is that inflation protection is entirely an accident of birth. Typically, we have high inflation in wartime, followed by high deflation as the stimulus is taken out after, and this is World War I was an example of this, World War II, where we ended up with 90% marginal highest tax rate because needed to fund the war, and then printed money to do it. Now, what we got from the Bush administration, and this is not political, it's just a fact, was guns and butter. And as you all remember from Econ 101, if you have both, eventually you'll have inflation. Under Lyndon Johnson, we had guns and butter, and eventually that led to inflation. I mean, the idea was give people benefits at the same time that you fund the war, and it's fiscal policy that usually leads to inflation. So for example, in the 1970s, when you add in inflation and so on, the average annual S&P 500 return, the real return, what do I mean there? All right, let's just say it was negative every year for 10 years, all right? And if you just happen to be in that high inflation period, and that really got bad in 81 and 82, it was an absolutely lost decade. For example, from 1968 to 1982, the Dow was flat. Absolutely flat. So, okay, it wasn't so bad, maybe I got some dividends, but the purchasing power, we argue over this, dropped 50%. John says he's seen higher. So most people don't think about inflation. They don't think about real returns, they think about nominal returns. A little known fact is that if you had been able to keep your money after the crash of 29, and of course the problem was most people couldn't, right? You lose your job, you have to spend your savings. But actually the purchasing power of the money was back in 7 years by 1936. And what we hear all the time is that the averages didn't come back until the early 40s for the S&P and the early 50s for the Dow. But that's nominal. In real returns, you had the same purchasing power by 1936. All right, and also in the 2000s, you can see a combination of inflation and stock market return, another lost decade. With inflation, it's when you're born. Stocks do not protect against inflation. Maybe if you had 40 years, 30 years, but most of us have a 20 to 25 year investing life. The kids, the mortgage, the underwater. Okay. John.
So one of my favorite charts in studies is called the capitalism distribution. A lot of people think that over time stocks go up. And as I just mentioned, that if you'd invested in Eastman Kodak in the late 70s, you'd be bankrupt right now. So most companies in capitalism actually fail, right? You have one winner and lots of losers. There's one Walmart and there's 40 regional retailers that don't exist anymore because Walmart has better technology, distribution, better ability to negotiate with suppliers and whatnot. So Black Star Funds did a really interesting study that showed that individual stock returns from 1983 to 2007, which was really the largest secular bull market in history, and certainly all of our lifetimes, most of the stocks were actually losers, and we'll show you this. So this is the actual distribution. 64% of the stocks had a lower total return than the index during this time frame. The index was up 900% and accounts for 98% of the liquidity of the US market, so that's basically all of the market. About 34% of the stocks actually declined in absolute terms. 25% of the stocks accounted for 100% of the market's gains, and about 1 out of 5 actually went down 75% or more. So just a very small fraction, about 6%, dramatically outperformed the index. So if you're picking individual stocks, it's pretty much about 4 to 1 against you by even finding a company that over a full cycle is going to beat the index. So again, if you're dollar cost averaging every month and using the Vanguard options, it's probably better to do the index fund than to pick individual stocks. The odds are just against you. I mean, these are the statistics that I just referenced.
I can't believe you memorized those.
I've been saying this speech a long time, I'll tell you that. So the odds are against investing success. So what do? Well, you need to avoid the big loser. Avoiding a big loser is more important to your returns than getting a big winner. If you lose 50%, you got to make 100% just to get back to where you were. So most people wake up every day in the investment business and they like to go find the stock that's going to go up 300%. That's what gets them excited. As a short seller and a forensic accountant, I like to find the company that's going to go down 30%. Where did that come from? Well, Tom and I were both born in upstate New York. It's cloudy about 400 days a year in Syracuse. So that's kind of where you get that mentality. Is that you, Tom? Focus not on what, the winners, but kind of on what you can lose. So if you lose less, you end up with more. I think it was Warren Buffett that said, rule number 1 is don't lose. Rule number 2 is don't forget rule number 1.
One thing to say about that, though, of course, is he's talking about never have a loss on a stock. He's talking on a portfolio basis, don't lose capital permanently. And if you're 58 years old and it's 2008 and you're off 38, 40, 45%, the clock has reset so much that you are pretty much looking at a permanent capital loss in terms of your retirement.
Yeah, I think we said in the book that you're drinking natural light instead of Dom Perignon, something like that.
That was your line.
Oh, yeah. If it was funny, it was my line.
I can't afford Dom Perignon. Yeah. He can. Oh, no. Show me. So here's what we're here to do. We've told you everything that can go wrong and why stuff doesn't work. And behavioral finance really was the breakthrough in this. When Richard Thaler met Daniel Kahneman, the 2002 Nobelist in economics, who is, by the way, a sociologist, and some of you may have read his most recent book, I bet. Thaler was an economist. I actually knew him when he was getting his PhD at the University of Rochester, and I always drop that name, even though I met him twice, bask in his reflected glory. He then went on to great fame and fortune. He was doing research one day, and he found out that this sociologist was doing exactly what he was doing, which was trying to find out why the Chicago School of Reactionary Conservative Economics was wrong. That we don't do rational things, that we do mental accounting, that we find $20 on the floor, well, that was then. We find $100 on the floor and we go, all right, dinner, drinking, whatever is the vice. And they have pretty much displaced the dominant economic theory, and it's one of the reasons why what we're going to talk about works. People don't behave rationally. You get emotional. People don't dollar cost average with discipline. They change jobs. They change options. And the same with asset allocation. They become afraid. They act emotionally. So what we're not going to do is just scare you and tell you how bad everything is because we've learned that people don't behave rationally. Rather, it's how to take advantage of that. And so we'll show you where you're going to die so you don't go there.
So what I do professionally is I'm a forensic accountant, which is 2 fancy words for reading numbers and finding companies that are using accounting in an aggressive fashion to mask a deterioration in their business. Every company has a bump in the road. So no company has just a straight trajectory in growth. We all experience negative cycles where maybe it's related to the economy or a competitor comes in or whatever the case may be. So the question is management open and honest about it? I'm talking about to Wall Street, not just the employees. Or do they cover it up? There's a lot of levers that management or a CFO can pull to mask a deterioration in their business. Most of us are optimistic about the trajectory of our business, and we think it's a short-term bump in the road. Unfortunately, the world doesn't really work that way, and what turns into a one-quarter bump in the road sometimes is a major secular decline, such as like at Hewlett-Packard, for instance, which we're seeing today. So the number one predictor is revenue related, and I'm going to get into exactly how to identify that. And then on Tom's side, it's buy valuable assets for 50 cents on the dollar and have a catalyst that's actually going to be realized, that value will be realized. So avoid the blow-ups. That's not my picture, but. So the 4 top earnings quality predictors, one is aggressive revenue recognition. The second is aggressive inventory management. In a company like this, you don't really have inventory, but certainly for older type businesses, inventory can be a key component of demand. Cash flow warnings and serial acquisitions, which we'll get into all those.
Hewlett-Packard.
So Wall Street wants earnings and they want revenues. And so earnings, it's all about the bottom line. Did you hit your bottom line number? One of the great things that Google does actually is they don't give Wall Street guidance. And so that means the analysts actually have to do work. They can't just plug it into a model and come out with a number that management gave them, which works in your favor if you're going to exceed that, the expectations that are out there. But it's all driven by expectations for revenue and earnings. So management's going to do whatever it takes, by and large, to keep the stock price up, keep the stock options up, protect their own job, make everybody happy. It's all driven by expectations. If you think about an income statement, you have revenue on the top and net income on the bottom. So the earnings that a company reports are the least important line item that they ever talk about. And why is that? Because between revenue and net income, you have, this pointer probably doesn't work very well, but you have lots of line items that management can utilize to derive whatever net income they want. So revenue is the most important. To the extent that I have concerns about a company, they're in direct proportion to where they reside on the income statement. In an extreme case, if the revenue for a company were fictitious, which may be the case with Autonomy that Hewlett-Packard acquired. We're really going to rag on Hewlett-Packard today, I think. Then the entire financial model would be fictitious. So why does it matter what the earnings are if the revenue is not even real? So when you're analyzing a company, you want to look from the top down. The net income number is the first line item on the operating cash flow statement. So when you analyze cash flow, if the net income happens to be manipulated, then cash flow quality is probably low as well. But the vertical depiction of an income statement really kind of helps, show the way that we think about things. So revenue-related issues, stuffing the channel. Stuffing the channel is a way of borrowing from the future and pulling into the present. So let's say it's September 28th and there's 2 days to go in the quarter, and we'll pick on another company, Oracle. So Larry Ellison gets on a plane and he flies all over the place and he says, look, I know you're in the pipeline for December, but if you sign the contract today, I'm going to give you 360 days to pay and I'm going to give you 35% off the list price. And you say, wow, that's great. I got 360 days to pay, that helps my cash flow. I'm paying less off the list price, that improves my margins, certainly saves on other expenses as well. So all I care about is that it gets implemented when you say it's going to, and it works out great. The problem is now I've stolen you from December and I've pulled you into September. So now I got to go to you and say, I know you're in the March quarter of next year, but if you come on in, we'll give you a big deal. So you're kind of a mouse on a treadmill. Eventually you run out.
But what it's really like is you borrow money. I mean, in additional to that is you borrow money from the local loan shark at a high rate, and then he wants his money, so you go to the next loan shark at a higher rate, and eventually you're dead.
Yeah,
because that's how they take care of you.
Eventually you get both legs broken. So it works until it doesn't. An example of a company that I wrote a research report on and subsequently shorted, actually was the largest short position ever in the history of our fund, is Asia Info Linkage.
Holdings.
Asia Info Linkage. But Tom wrote this stuff.
It's always my fault.
Yeah. But basically they're a telecom provider in China. And they have what's called percentage of completion accounting, which means that they provide software to a customer and then they go implement it and they get to decide, management gets to decide how much of that project is actually done in a given quarter. So they estimate not only the revenue, but also the margin on it. So you only know the total revenue at the end of a project. If it's a $100 million deal, it's a $100 million deal. The problem is if I want to be aggressive, I can recognize 90 million of it in one quarter and then the 10 million over, say, 3 more quarters. So you can front load the revenue recognition. Well, this is the only company in the history of my career, and I've probably looked at 1,000 companies, that over 100% of their growth was coming from percentage of completion accounting, which is just, I'm not a math whiz like you guys, but I know enough with 4-function calculator that you can't have over 100% growth come from that factor. And then you slap on top of it, it's a Chinese company and they have some question marks with respect to their corporate governance, and put 2 and 2 together, and then this is what happens. Stock price implodes. This black line's about where we got into it, 21. It ended the year just under $9. Day sales outstanding is what I just explained with Larry Ellison. He gives you big terms. This is Deckers. What Deckers did was they make UGG boots, the sheepskin boots. They extended payment terms to their customers, basically incentivized them to go take on a bunch of inventory that they didn't need in order to get it off of Deckers' balance sheet, and the stock, which went from being a growth darling, imploded. Another one of our big short positions earlier this year. Aggressive inventory management. Companies have raw materials, work in process, finished goods. Green Mountain Coffee Roasters, which was up big today on the announcement of a new chief executive officer, has huge inventory issues where they've been building up the coffee machines and the actual K-cups themselves. If changing a CEO would really help a company, then Hewlett-Packard would be in better shape than they are right now. So we see that Green Mountain has also imploded. It's up a little bit from here, but we actually think that they're going to have to write down the acquisitions that they made recently, as well as potentially write off some of that K-cup inventory. These are K-cups, by the way. I don't know if you guys use them here. But these are stockpiling up at your local Albertsons, so if you want a discount, you can just go over there and get them at 50% off. Cash flow warnings. If the receivables and the inventories and the payables are all moving in the wrong direction, it can show you that the cash flow is actually not coming into the business. So revenue and earnings are important, but cash actually coming in is important. You guys like to get paid in cash, not
Just one second on that, John. Familiar with Rambus, which is a Silicon Valley company? I thought maybe. For years, right, everybody thought they had this great IP and they were going to win all these cases and that they had all this cash flow and so on. And actually there was a period of 5 years where the only operating cash flow that they produced was from adding back stock-based compensation. So actually they weren't an IP company, they were a options-giving company.
Until that ran out, as
Right.
we know, and then the stock price imploded. WMS Industries is a company that makes slot machines in Las Vegas, and they were offering huge incentives to their customers to take on inventory in order to get it off of WMS's balance sheet. They did a lot of that channel stuffing. It was reflected in the cash flow statement, and this was actually the first stock I recommended to the Motley Fool when I came back to the company at about $39. It went to 48. Everybody screamed and yelled at me, and now it's at 20. So. And by the way, when I recommend these to go down, that's what I'm recommending them to go down, not up, in case people don't. Serial acquisitions. Oh, Hewlett-Packard. Have we talked about that?
Gosh, I forgot that company somehow.
When a company's really going sideways, they make a lot of acquisitions. It covers up weak cash flow. You can stuff a lot of stuff on the balance sheet and expenses. So you can basically understate your expenses and overstate your profits by moving it onto the balance sheet. You can assign a lot of the value of something to goodwill, like a company like Autonomy, which is potentially a fraud. Palm, for instance, which was a big write-down, about a $1.2 billion write-down. I think they wrote down $9 billion of EDS. So a total disaster. Cisco Systems has been a heavy acquirer for years. They used to do it under the old rules called pooling of interests, which is when you merge 2 companies together. That no longer exists. Everything is what's called purchase accounting. So that has the ability to really obscure the financial statements. So you want to look at companies and whether or not they're making serial acquisitions. They really get hammered in bear markets when access to capital gets shut off and you can no longer finance it with debt, or your equity is worth a lot less because the stock market is going down. And now we're up to Tom and buying on the fire sale. Oh, he's asking what happens when the company goes public, so on their initial public offering, and they're flush with cash, and then they make acquisitions. It actually still obscures the financial statements, because the way the purchase accounting works is from the day they make the acquisition forward, it's two combined companies, not ever looking back. So if I have $100 in revenue and you have $10 in revenue, I can make it look like 10% growth even though nothing changed. Under poolings of interest, which is what Cisco, when they were really growing, was doing, it actually made the company look like they were combined entities all the way back into history. So even if I'm flush with cash, I can still obscure the revenue growth, I can obscure my cash flow, I can do all kinds of shenanigans on the balance sheet to move expenses off there, to create all kinds of goodwill that doesn't really exist. And all that's just leading to is big write-downs in the future, and ultimately that's reflected in a poor stock price. It doesn't really hit you until like a bear market when you can't make the next big acquisition because the equity markets or the debt markets aren't available to finance it.
Think about it as each time you have another child, right? You're a different company. Your expenses are different. You can't compare what it was like last year when you only had 6 kids. Now you have 7, right? Or 1 and 2.
Never thought about it that way, but okay.
No, but you see, so your budget, if you're doing year-over-year budgeting, right? It's not apples to apples. So what a Hewlett-Packard does is they just keep buying every year, so you can never see what the family is really doing. Okay, they're like box family. What do you have? 23 kids? All right. You can move to the side now, John. You know, you've just kidding. I've talked about behavioral finance already and how that changed the viewpoint. Of course, Benjamin Graham didn't need to know behavioral finance in the 30s after his brother-in-law had to bail him out after the market crash. Nothing worse than that, right? Having you depend on your brother-in-law. And then he resolved never to lose money again, invented modern value investing, taught Buffett at Columbia, gave him his only A+, gave him his first job, and then Buffett went on to very great things, of course, and Graham continued his adultery. Okay, this is very, very simple, and there's so many books written on value investing. It's one of the reasons I'm last. But one of the things that I should, and very few on this, and ours, of course, is the best, because we don't give you a college textbook. We pick the top predictors that John has seen over time. I do all that work before I even get to the value side. I don't even look at a stock until I've done the earnings quality analysis. This is Graham's Mr. Market. This is your business partner who, when everything is great, wants to pay you any price for your half of the business. That's when you want to sell. This is Mr. Market when everything's awful and things are going to get worse and never going to get any better, and please take my shares for whatever price you want. Okay, this is when you get to buy dollars for pennies and then sell them for more than they're worth. Tweedy Brown did a study of many, many decades, 50 studies they looked at of what actually works. They found 5 characteristics. And I'll go through each of these. The first is you want to buy an asset for less than it's worth. And this happens because of emotional markets. You get the chance. Efficient markets theory that many of us learned in finance or MBA school is just no longer, it's, you know, these poor Chicago Nobelists are now reduced to writing in The Economist ad hominem attacks on the behavioral finance people because they can't think of anything of facts to refute it with. It was very sad to see Lucas, a great, great mind, writing in the back of The Economist and addressing no facts. I like tangibles. I like things I can hold on to because they're easier to value. It does not mean they lose value. A building with cash flows, gold in the ground, silver in the ground, oil, gas. I like things I can taste, touch, feel, smell. I don't own Google. If I did own a tech stock, whatever that means anymore, if I owned one with intellectual property, this is the one I would own. And that's not just because I'm trying to suck up, all right? But
he's good at that.
Yeah. But I have this friend, known him since we were 16, and he's always been just this incredible genius. He talks like this, and probably there are a few at Google who are like this, very smart people that kind of talk like this. And He is now a muckety-muck professor at Case Western, senior, just got a great job, you know, basically given all this money, make this the best engineering school in the country. You know, they got a huge amount of money. And as I was telling Alex at lunch, I went to see him, we had a friends reunion in August, and he told me, Tom, I just want to explain why you need an Android phone, okay? I just want to explain to you why Google is great and Apple is now as evil as Microsoft, all right? And he showed me the amount of data he is processing all around the world all day long. He's doing all his testing solar panels. It's all amazing. Free Google software. He is using something probably some of you made, and it's free. And he could not do his job without it. So all these companies that he's testing, whether these solar panels will really last 20 years or not, free Google software. That's all it took. I was done. I mean, you know, I can't value a Facebook. I don't know if it will become like MySpace. I think the advertising model is a great one. I was just never very good at intangibles, right? Tangibles, they have prices. They're quoted every day. Commodities, rents for commercial buildings. All right, I think I've beaten that horse to death. Low multiple of cash flow. Now, Tweedy Brown used PE, and that's because for decades and decades and decades, the price to earnings ratio was all you had. In fact, it was only in the late 1960s that companies were required to report the cash flow statement at all. Value investors love the balance sheet and the cash flow statement. And part of the reason, as John has demonstrated, the income statement is not the only one, but a large place where the shenanigans, or chicanery as we say, take place. So I'm looking for low enterprise value or market cap to free cash flow. How much actual cash is the company throwing out? Now, it can be a trap. Bridgepoint Education is one of these not-for-profit education companies, and selling basically for $1 more than net cash per share on its balance sheet. You'd think it would be something I would love, buy a cheap asset. But it's intangible. It's not buildings. It's whatever brand they have that can get students to get government loans, to pay for courses, and maybe not get jobs, because the industry is very much in its infancy. So you would think someone like me would buy it down here. Price, of course, is not a reflection of valuation, but in this case, it's very close to net cash. I'm buying an asset for a very low price. I have cash protection. But I really don't know what that asset is worth. So I can't say, am I getting it for 50 cents on the dollar? That's called a value trap, where value investors will get all excited about it and nothing happens. Why do we care about low price to assets and low price to cash flow? If it gets low enough and the business is at least steady state, someone will buy you. Guaranteed. Or someone will come in and say, you're running your business terribly, it's reflected in your valuation, I'll buy up a lot of your stock, Carl Icahn, Bill Ackman, and some other names that are not household names. They'll buy up a lot of stock and agitate for you to spin off a business. Berkshire Hathaway gets what's called a conglomerate discount because we know he will never sell off businesses. If he did spin off businesses and you owned Berkshire today, your stocks all together, after he spun off the businesses in the public markets, would be worth more. So we say it's a conglomerate discount when you don't think they're going to spin off businesses. You're never going to realize that. So activist shareholders will come in and try to create value through catalysts to realize value, such as spin-offs and mergers and so on. By the way, everybody thinks that their merger is going to be like Lake Wobegon. 85% of them don't add shareholder value. 15% do, according to a study at Harvard. But everybody thinks their acquisition will be above average. Share repurchases. Tweedy Brown looks at insider buying in their 5 points of what works in investing. I would say that most insiders of companies are no better investors than the average investor, a lot of them. Now, they do know stuff. They do know that things are coming down the pike, but of course they're prevented for acting on a lot of information in certain legal circumstances. So I prefer to see share repurchases that are bought when the valuation is cheap. When I would buy the stock because it's selling for a discount to assets, that's when I want the company buying back stock. I want them buying back stock when that investment, when the stock value is so much below its real worth due to emotion, due to the Mr. Market we saw, fear, that's a better investment. Buying back the stock at a discount, it's like me or you buying the stock at a discount than wasting it on acquisitions that destroy value. I've never owned Berkshire Hathaway. I would today because they now have an absolute policy. They buy back stock whenever it's 110% of book value, shareholder equity, or less. Automatic, down to where their cash is $20 billion. They have a lot more than $20 billion. So that's like a support under the stock. Every time it gets to a certain low value, they whoosh in, they buy it. It's protection. Fourth point is a large decline in stock price due to emotional reaction. That's because stock prices tend to revert to the mean, which is why paying up for a hypergrowth stock almost always ends up in pain. What goes up must come down. What goes down comes back up. Now, obviously, not in the case of Google. All right.
But yes, in the case of Apple. So.
Yeah, but in the case of Apple, right? Now, I apologize in advance for choosing the Macondo explosion in the Gulf. This is obviously a horrible tragedy for the people on it, for people who depended on the Gulf, for the environment of the Gulf. However, I think that by choosing something like this, something so extreme, it's useful to make a point. So I apologize in advance for saying you could make money in this kind of environment. But I think that it shows you that in far lesser circumstances, you can as well. So this is an emotional event that will cause assets to sell at less than their real value because everybody throws it out. They're scared to death, right? So that blue arrow is Ensco, a driller, oil rig owner and driller. They rent themselves out, these big, huge semi-submersible that drill 3,000, 12,000, 10,000 feet below the ocean for oil, and which, oh gosh, I'm sort of in your way, and which produce where the oil is coming from today, really. Okay? So Macondo happens. Transocean's Deep Horizon rig blows up. All the drillers go down, every single one. BP crashes, Transocean crashes, all the drillers you can imagine, which, of course, at the particular moment, being in front of you, I can't summon up. But I know what I did. That weekend, I went home, and I looked at all the drillers, and I said, this is a time to look for a company that has little to no exposure to the Gulf, has an excellent safety record, but yet has been hit like all of them. Has a great balance sheet, and Ensco was the one I picked. Eventually, you had reversion to the mean when the fear was over. I happened to sell not at the top. You never buy at the bottom or sell at the top. But we made some good money for special ops members at the Motley Fool. I think that others did better. If you bought BP, may have done better. If you bought Transocean, you definitely did better. But why didn't I buy it? Because I couldn't value the asset because the liability was unknown. We didn't know how much they were going to end up having to pay. It was a big unknown. With Ensco, I could see the contracts. They have them on their site where all the rigs are and so on. All right. Small market cap is a key element. Small companies, there's less information about them. So you get, if you do the work, you can uncover gems. However, they tend to be more volatile because they have less volume. So here's one of my favorites because it was a success. We all have failures, but this one has worked out well. But just a little bit of volume there, that's what I guess they call gapping up. I mean, it just zoomed up when the Mexican tax authorities gave them a favorable ruling on treatment of silver taxation, giving them another 20 to 40 million a year. When you're a $200 million market cap company, 20 to 40 million is a lot of dough. However, it's been very volatile, right? Overreacted, Now coming back down. All right. So what happens, though, is that the more money you have, the fewer small caps you can buy. I mean, Buffett has $43 billion in cash. You think the $240 million Primero Mining matters to him? It doesn't even, cliche alert, move the needle. So as all these guys, the great Yale University endowment manager, David Swensen, and many say, size is the enemy of returns. Decreases the universe of stocks you can buy. If small caps provide the best returns over time, provided you apply all the strategies I'm pointing out from Tweety Brown, you all end up like rats in a large cap cage. All these big companies, they're looking at the same ones. They're trying to find if you're $1 or undervalued, or Microsoft $2, or it's all the same companies, and it's really hard to make money that way. So, what do you do the more money you have, which would be a nice problem for a lot of us to have, I don't know, $1 billion or something. You look for activists, you look for catalysts in large caps. These will be people like Ackman at JCPenney, who has control General Growth Properties, which he was scooping up at 50 cents, which is $19. Carl Icahn is now doing this in natural gas at Chesapeake Energy. I'm a big natural gas contrarian. And of course, in this to succeed, you have to be contrarian. Now, whether that will play out, I don't know. And then other catalysts that unlock value. They can happen with big companies. But it takes somebody to get in there, get on the board, and make stuff happen. That summarizes that section. And if we still have time, John will give a view of market conditions. We'll have a couple funny slides at the end, and we'll take questions.
Yeah. As a short seller, I'll try not to be too depressive about where we're about to head into, but so I'll do my best.
We are from Rochester and Syracuse, we said.
We'll try to end on a positive note. Yeah. As I mentioned earlier, average investors or individual investors are not very good at asset allocating. Well, neither are professional investors. It's probably going to be hard to see with this pointer, so I'm just going to use my fingers. And this, again, is the low in 2009. And their average equity allocation was about 0% stocks. So they're telling you not to own any stocks at the exact crisis low. This was when the US debt got downgraded by Standard & Poor's and everybody was jumping out of buildings. This was about September, October 2011.
Well, not everybody.
I wasn't. 0% equities, okay? And then in March of this year, they were at 75% equities, which generally when they get that aggressive on the bullish side, the average returns are negative 7.7%, and that's right before the market had a reasonable pullback. So right now, active investment managers are fully invested, so that's a contrary indicator.
As contrarian as the individuals that we saw.
Right. This is what's called the Shiller PE. This is like the long-term smooth price to earnings ratio on the market. It's at essentially 24. A bull market's never started when the Shiller PE has been 24. This has an implied negative return of about 2% annualized, where it is right now. In my opinion, the E is overstated.
John, negative 2% annualized, like Husband, like 10 years out, or
over the next 12 months.
Oh, okay.
And so, in my opinion, the E is overstated. That's the earnings, because profit margins are at all-time highs in the United States, and they're mean reverting. So, for instance, if you guys had a profitable project, chances are some sort of competition will come in and at least try to squeeze that down a little bit. In the case of corporate profits across the United States of America, they're unsustainable highs. So if profit margins mean revert like they've always done since the history of the world, then the E is going to go down. If price stays the same, then the PE ratio.
So John, so we're looking more at this than that.
Yeah.
Yeah.
This is the volume of the market. Stocks, most people like to think that they're investors for the long term. The average stock is held for 21 seconds today. To put that in perspective, a lot of that's driven by machines, of course, computerized trading. But stocks are just like milk or gas or clothes. They're commodity like anything else. Supply and demand drives the price. So this is the secular bull market from 1982 all the way up to 2000, 2001, before the internet debacle. If you notice, volume basically trended with it, right? It was going up as the stock market was going up. What you have now, though, is the stock market's going up, and the volume is actually going down. And what didn't exist back here, even in 2000, was what's called high-frequency trading. These are these computer machines that just trade very rapidly. In the last 5 years, the volume of high-frequency trading is up about 700%, but the profits are down to about 1/6. So they're squeezing less and less lemon juice out of the lemon. If you were to remove that, then there's nobody in the market. There's really no buyers right now, other than maybe Ben Bernanke and the government. But if we were to have a reasonable...
No politics.
If we were to have a reasonable correction, say 15%, there's really nobody underneath here to support prices. I went to the New York Stock Exchange on the floor about 2 years ago, and I was shocked to see that there's nobody around anymore. They're basically reading the New York Post and playing cards on their iPads. And what in the old days happened was there was a specialist, someone who's responsible for a stock, and that person's job was, if that stock was crashing, to step in and buy it and to protect the integrity of the markets and the shareholders. But that's no longer really the case. So this is a very dangerous trend, and this implies about 2% positive returns right now where we are annualized. This is the scariest chart of all, but I said I was going to end on a good note. So this is what happens in secular bear markets. Secular bear markets are long-term bear markets, like what happened from 2000 to today. The stock market's flat. A secular bull market is from 82 to 2000. And then within those big picture markets, you have cyclical bears and cyclical bulls that last maybe 3 or 4 years. The average duration of a cyclical bull market is 39 months. This is going back decades to the start of maybe 1900s. We're now 44 months into it. So the next cyclical bear within a secular bear is going to be nasty. That's where you're going to want to put a little bit of cash, in a can somewhere in the backyard. Because here's what happened this is the Dow Jones Industrial Average.
Get these things.
These are the best companies in America. These are the ones, aside from Google, these are the ones that have solid cash flows. They're multinational. They probably generate more than 50% of their revenues outside the country. They can pay dividends, yada, yada, yada. These aren't, companies that are one product, one trick ponies. So the cyclical bear markets within the secular bear are negative 29.7, negative 31.5, negative 53.8, and negative 16.8. So if those are the best companies, the best position with the best balance sheets, what do you think is going to happen to all the companies underneath that don't have the financial stability that the best ones do? Well, on average, according to William O'Neill, they go down about 2 times the average index. So on a 31% decline here, you could see a lot of small caps go down 65, 70%. But since I said I would end on a good note, other than buying Google stock, what can you do? You could buy dividend growers and initiators. Since 1972, they've gone up by 9.5% annually. The S&P 500 on an equal weighted basis has gone up 7%. And for all you math whizzes out there, you know that 2.5% compounded annually over 40 years is a big difference in how much money you're going to end up at the end of the day. All dividend payers are about 8.7%. And then here's the one to avoid. The non-dividend payers in the S&P 500 have grown at 1.5% compounded annually over the last 40 years. 40. So that's not even the rate of inflation. So if you want some protection, you could buy a short fund like what I do. You could go into Tom's domain, which is small cap value, or you could pay attention to dividends and buy large cap dividend companies. The Johnson & Johnsons, they're still going to be making Band-Aids when you and I are long gone.
And which is 5% dividend right now, which is unheard
huge
of
yields.
for them.
So Tom, you finish up here.
So I'll take it out, as they say. So we obviously think that a long-short portfolio is the way to go. Use earning quality analysis to avoid sell or short stocks that have the top predictors of poor performance ahead. And then we buy stocks offering value with catalysts. When we talked about small and how small gets hit in these situations, that's also when you keep buying, right? There's a lot of volatility with small. Doesn't mean they're bad. You just have to have a longer time frame. And when your shorts come in, you take those profits and put them into the things that have been hammered. So you don't want to, the idea is you'll go from this. You can all see the books upside down, right? All right. To this. And then perhaps you'll even be in a position to where at Sunset in La Brea in LA, you'll see this. Thank you very much.
Thanks. That is our billboard, by the way, by the Hollywood Walk of Fame. So
Yeah, that's not like
Yeah.
Photoshop.
It's not superimposed.
You know?
Photoshop, yeah.
Questions? Do we have time?
I guess so.
So I know you haven't said anything about HP,
Yeah,
and you've also
never heard of it.
And you also recommend not buying large cap stocks. And HP is not, at least not yet, a large cap. But I was wondering.
Oh, it's a large cap.
No,
I know, I know.
Oh, you're kidding? Sorry.
Soon to be a small cap.
Really small cap. So the question is, as value investors, is that a good investment now at 11?
What, Hewlett Packard?
I wouldn't buy it with counterfeit money.
No, and the reason for that is simple. The balance sheet is terrible. So when you're looking at value, right, and I don't know, I mean, you know, what do they have? Tangible, intangible. They have massive amounts of debt. In fact, I write this section in the book after John said, write Hewlett Packard. Massive amounts of debt, and they're still paying a dividend and buying back shares, and they're writing down the value of acquisitions all the time. This is not a value stock. Somebody, Alex, you were saying that it was written that all these top value guys have been killed in this stock. I agree with John.
They do a
Wouldn't
lot
touch
of
it.
what's called recurring, non-recurring charges. So they take a charge every quarter, but it's non-recurring, but then it happens over and over again. I would wait until all that's been flushed out and they've pretty much written everything off their balance sheet. And then once they've thrown it in the kitchen sink, then you could sit back, analyze it, and look and see if they have assets that are worth more than whatever the
Right
share
now,
price
you
is.
just don't know what really is going on
Kind of
there.
hard to decipher.
All right, she asked what asset classes are attractive today. Gold, she said, was at a high price. Stocks at a high price, and I'm sure John has something. Yeah.
I'm a pretty big gold bull. I've been a gold bull for the most part of the secular bull market in gold. And generally, the secular bear markets in stocks, like that second to last chart that I showed, they don't end until gold is about 1-to-1 or 2-to-1 on the Dow Jones Industrial Average. So that means either the Dow's going to 5,000 and gold's going to 2,500, or if the Dow stays at 10,000, gold's going to 5,000. And to put that in perspective, it started at 34-to-1 in 2000, 2001 when gold started to take off. So I think gold has
34 what to?
the Dow Jones Industrial
was
Average
34 times
34
gold?
times the price of gold, and now it's about 8-to-1. But eventually, that spread will narrow before you get into the next bull market in stocks. So I'm still bullish on gold. In terms of yield, that's a tricky one because we've been in a 30-year bull market for bonds as well. I believe it's the first time that bonds have outperformed stocks over a 30-year period. I like some certain high-yield bonds. There's like a fund that we know
we
in
love it.
service called HYLD. It's the Paradis High Yield Fund.
That's the ticker, HYLD.
they're
But that's
very-
not a recommendation.
It's not a recommendation, but they're very good at picking, certain high-yield bonds. Otherwise, it's very tough to find yield in a zero interest rate environment.
John, if I could just add, part of the reason that we also are very interested in HYLD is that it's led by a guy who's a value investor in bonds. And one of the things I didn't pick on was jockeys. If you know someone does something really well in an area you don't know anything about, and the person has done it over and over and over and succeeded every time, that jockey can ride any horse and win. And Tim Gramatovich at HYLD is a value investor in bonds. I know squat about investing in bonds. And he is really, really good at it. And he started with Michael Milken. I mean, he sat at the feet of the masters. So.
Yes, sir.
So, nice presentation. To me, it was very much a fairy tale. The science, 70 years of financial economics show there's zero evidence that you can pick stocks, zero evidence you can time market, and you mentioned that behavioral economics is the the trend that's taken effect, but really that's not the truth. 90% of economists still believe that behavioral economics is just
So you would say that because 90% of people believe something, it's right?
The science does not support this.
No, but actually, I would disagree entirely.
And
It's okay.
and then
So
things like
it's a statement, actually. So yeah.
yeah. And then one thing that I saw missing throughout the whole thing is that Finance 101, there's no free lunch. You didn't mention the risk. If value stocks have higher historical expected returns, is because they're riskier throughout riskier times. Because when crisis hits, because when everything's going down, they go down more. When you lose your job, your investment's also down. So that's why, because you're taking higher risk for higher expected return. It's not like that, okay, I'm investing in this thing and I'm making more money than others.
So what's your question?
So I'm saying that, I mean, all these points were missing, so.
No, but what is missing really? I think you might be making two fundamental mistakes. One, that all the studies show you can't outperform the market. I think that's a statement that is just wrong, right? Because there are studies that do show that you can when you, you know, when Tweedy Brown set out to do it, they read everything, absolutely everything, every academic paper they could get their hands on. And what you do is you wait until the market throws something out, and if it's not crazy, then you wait for it to revert to the mean. If value investing didn't work, David Swensen, I mean, everybody says Buffett, and everybody goes, well, Buffett had an unusual situation. I can name you 30, 40, 50, 60 managers, 100 managers who have done this. Buffett's famous paper in 1984 at Columbia, he talks about this. Now, when you say 90% of the economists think something, I generally think, well, it's probably because their graduate students, in order to get a job, have to do what they say or they won't get recommended. And we all know that in fields like psychology and psychiatry, where cognitive behavioral therapy is all the rage, you can't get a job if you do EMDR, which is now the standard of care in the military for PTSD. So the world moves according to what your particular investment is. If you're a Nobel economist, you are not going to say, I was wrong, right? But there must have been a reason that a sociologist in 2002, was awarded this in behavioral finance. I would just say that we can argue about this strongly, and there are obviously many points of view. But I just can't accept that that all studies show that nobody, blah, blah, blah. That's sorry.
Yeah, we could argue about it all day, so we'll go on to another question, but I'll just say that I started my career as a quantitative analyst working with high-powered computers back then, and the market, which is generally viewed as the Standard & Poor's 500, is market cap weighted. So that in and of itself is a strategy. They just decided, which right now is Apple, would be number one. That's the 31st percentile of all strategies in terms of performance from 1929 to 2007. So there's billions and billions of dollars that have been made and are actually managed on these quantitative strategies that show that 69% of the strategies that we created actually outperform the market. So it's done it in historical testing and it's done it in real time. Beyond that, I don't really know. I mean, we could sit here and kind of slice it a million different ways. So I'm just going to go kind of based on my experience. But yes, sir.
I just want to see if I got your point correctly. So you started with saying that you have to protect yourself from losers and how to spot losers by looking at the sheets, right? And then at the end,
protect yourself from losers and what?
By looking at the financial statements?
Yes, right, yes.
and then you said at the end that probably the market's going to go down and there's going to be like tons and tons of losers. Isn't it like a big opportunity to make money?
Yeah, absolutely. I mean, I'm a short seller, so that's a big opportunity. In 2008, which was the largest crisis of our lifetimes, we did very well. We did very well in 2001 and 2002 as well. But in a normal cycle, like 2004 to 2007, the market still went up every year. But there were pretty big opportunities to find companies that were going to blow up or underperform because the volatility was very low and in general, expectations were very high for the market. Since 2009, the market's either been straight up or straight down because of these central bank interventions that are occurring. If we get back to a more normalized environment someday, then paying attention to these warning signs is going to be really crucial, even in an up market as well. Yes, ma'am.
So you mentioned like over 60% of stocks underperform the index. So does that mean like if you long the index, but short individual stocks have a better chance to?
That's a great question.
All right, what was the question then?
So she asked that nearly 2/3 of the companies actually underperform the index. So why not be long the index and short individual companies? That's exactly how we ran a hedge fund for 3 years before we launched our ETF. We went long the index and short our stocks. I can't tell you what the returns are because I'm not allowed to, but it is a very viable strategy. If you can pick individual companies that are going to fall by the wayside, even when the general trend of the market is up, then you can capture the spread between the two, and you've offset some of the risk of just being short or just being long. Yep.
So even considering the additional margin cost for the short positions?
There would be, if
She asked, does this also include the fact that you're paying interest to the broker who's lending you the money for you to buy on margin
Yeah.
when you're short?
the best, or maybe the only way for an individual investor to do it is through interactive brokers. They're the only ones that really have enough inventory of short positions available to allow you to pursue that kind of strategy. And they're also the cheapest provider in the marketplace. So the cost of shorting most stocks, which is general collateral, is about 40 basis points. That's what it would cost you.
IB, right?
IB, yeah. You can't do it through like Schwab, for instance, because they don't offer enough inventory of shares to be able to short them. It's just not their business model. Yes, right. Well, we'll get him first, and then we. Yep.
I mean, I just want to add a quick question about short selling, and it's been, this might be wrong, but it's been my experience that short movements oftentimes happen quite rapidly, whereas long movements happen over time. They can also happen rapidly, but just an aggregate tend to happen over time. So as someone who can't be involved in trading stocks every day for 8 hours a day or analyzing for 8 hours a day, you know, what sort of strategy might I have to actually do short sales?
Well, you could buy an ETF that has individual short positions, but this isn't a
No, John's
commercial.
not promoting.
Yeah, no, you're right though, because people run for the exits really fast generally. But there also are those kind of secular declines. I'll give you one that we shorted, Research in Motion, which we probably shorted somewhere in the 50s or 60s, and now it's in the low single digits. We got out of it way too early, probably around $18 is a rough guess. But that's just been a long, there's been a couple huge moves down, but it's also been kind of a long slope down. And I believe it's chapter 7 of the book. We give you some technical tools that you don't have to watch intraday that give you some warning signs to show you that the stock is already starting to break down and could signal maybe now's the time to get in there. I don't think what you need to be doing is looking at intraday quotes and really trying to time it on a real short-term basis. In fact, I don't even have a quote machine. I don't look at quotes at all except for end-of-day quotes, but never intraday. So I think that when you have a chance to peruse the book, you'll see some strategies in there that'll allow you to take a little bit of a longer time frame and still be able to pursue that approach. You had a question, yes?
You mentioned that you prefer large cap stocks with dividend. I think most of the S&P 500 are paying dividend. Do you have a threshold that you have to pay 2%?
Okay, so this was a question talking about large cap dividend payers. Is there a threshold for the yield? Is that what you're saying? I would like to just address that one of the issues, unfortunately, with dividend payers is that it's not just yield. Unfortunately, you really have to look at what percentage of revenues, free cash flow, and income is getting paid out. Because the last thing you want is the dividend to get cut. For example, shippers. They have good times, they pay 11% out, 12%, that looks really great. But shippers they pay everything out as dividends when times are good, and then they cut it when it's down. And it happens over and over and over again. So as a rule of thumb, you don't want a company that's paying out more than 50% of free cash flow or net income. So you do have to actually look. The other thing is if they're growing, it's more likely that they will be able to increase the dividend. Fair enough?
Yeah, I was just offering that up as a solution other than kind of shorting the market if we get into another cyclical bear market. But if you look at, and I believe this goes through 2010, from 1980-ish when Apple went public, and compared it to Philip Morris, which is pretty much a sleepy cigarette business, multi-business units. Apple stock is up, I'm making up the numbers now because I don't have it in front of me, but it's up like, say, 7,500% or 10,000%. And Philip Morris, with those dividends and reinvested dividends, is up 20,000%. In other words, the dividend is a real key component to long-term growth in your portfolio. And so you should at least think about them when you're going out there and picking individual stocks.
And I think that the point also is protecting yourself if we're going to have a large drop. I don't think it's like suddenly we're talking about the long side of the portfolio conforming to the points that I made from a study. It's something you might consider facing the kind of long-term, possibly negative annualized returns that the market is telling us we'll have. Now, to be fair to your question, in another way, The answer easily is dollar cost averaging, discipline. That's really the response, because otherwise, what do you do? But and that gets us back to whether you can do it. Some of you can do this. I know people that can do that, and they're disciplined. But what I didn't want to do at the beginning was to have any doubt that the academic studies show most people can't do that. And that's where the opportunities come in. But if you can do that, you can do that and go home, basically. But it's got to be consistent.
We got it, Tom.
So you're kind of alluding to the fact that you think that we're going to have another one of these March 2009 drops. And one thing you could do is just say, well, I'm going to go to cash in my portfolio and wait for that to happen, and then I'll buy at the bottom.
But you never know when that's...
But one of the concerns that I have with that is if you put everything in cash, what happens if all of a sudden the dollar is worthless?
Yeah,
The Chinese decide that the yuan's going to become the world currency, your cash is not worth anymore, or just the inflation drives the cash to be not worth while until the time of that.
That kind of adverse move will probably happen fast. First of all, it is going to happen. I mean, you're going to have panics and crashes. I don't know when it's going to happen. It could be next year or the year after, but you're getting into an aged bull market was kind of my point. You're beyond sort of the normal duration. The dollar will probably rally in that environment, and the reason why is that outside the United States, there's a lot of short dollar trades that are on by hedge funds, for instance. They've been using the dollar as the funding currency for their highly levered bets because interest rates on the dollar are essentially zero, so it's not costing them much, if anything, to put that trade on. So when the market tanks, they have to meet redemptions because people are yanking money out of their funds. When they meet redemptions, what do they have to do? They have to raise cash. How do they raise cash? They unwind their short position. What are they most short? The dollar. So the dollar actually spikes. So if you look in 2008 during a crisis, the dollar actually spiked. The dollar actually spiked when the US debt got downgraded last year. Why? Because people got nervous, and every time they get nervous, where do? They go to the United States, and they repatriated their short positions. That won't always be the case. I think you've got a valid point about the Chinese currency, and that actually the Chinese have removed, I believe, 10 or 13% of their treasury holdings this year. So they're clearly shifting away from that. So the only reason why the United States gets away with everything that it can do politically, we can get in all this stuff, is because it has the reserve currency of the world. So as long as that's still the case, I think you're okay with going to cash. When that's no longer the case, then yeah, you absolutely need to find something else. But go back to March of 2009 when 45% of the AAI was in cash. Would you have the gumption to be able to go in there and just buy stock? I mean, that's what you have to ask yourself. Only you can answer that question.
Well, and here's how I dealt with it. Because I'm valuing stocks, right, all the time, according to cash flow, according to net asset value. After learning in 2000, 2002, when this started happening in 2008, and I know that small caps get hammered, but they also bounce back faster and higher, because when you sell and you're illiquid, it has more of an effect on the stock price. So the thing, it's my watching the portfolio go down and down and down. And what I do is I sell the higher valued stuff, higher ratios, and buy lower. And you just keep doing that until there's nothing left that's more attractive. And you say, well, I'm taking losses. Well, it was my rollover IRA. But nevertheless, the studies would show that the returns from this outpace the tax consequences. It got to the point where it was March 2009. I had no idea it was the bottom. Nobody knows. John actually has a pretty good record with market timing in certain situations, but down to the day, no, nobody has a clue. In March 2009, had nothing more to buy. Everything I knew was a buyout candidate, right? And I just said, okay, someday this is going to revert to the mean. And so, I was down a bunch in 2008 and up 70% in 2009. But this is the volatility issue. It's why you can make money in small caps. People say to me, well, Tom, I didn't have any money. Well, you always have money. You just have to know what you own. And then you switch out of the less attractive, more highly valued, to the least until there's nowhere more to go. Now, if you have the short side, of course, the short side is making you profits that you can reinvest. And so this is a very hard concept to explain. And also, it's not something, you can just do in 10 minutes on Saturday. I mean, we'll admit that,
Last question.
Last question, yeah, go ahead.
So does the like real estate market has the same kind of cycle with the stock market?
Residential or commercial? She's asking about the real estate market. Does it have cycles like the stock market?
Maybe residential, because kind of feel like the housing is just starting to pick up, while the stock market has been like higher for a while.
Well, the thing is, I would never buy a residential home builder, ever. And that probably means there's a lot of money I won't make. Because real estate is only worth the net present value of the cash flows from it. So really, your house is only worth what you could rent it for, discounted to today. Well, I mean, how are you going to, it's so crazy. You've got to know the difference between one street in Palo Alto and one street in Sunnyvale, and I can't do that. Now, with commercial real estate, all right, particularly with real estate investment trusts, if you know the capitalization rates, sorry for the jargon, that the CEO is paying, if you can see the prices being paid, you can get an idea of the value of that building versus the cash that it throws off. Give you an example. There's a Southern California guy named Stuart Tanz who buys strip malls. He doesn't buy fancy, Fashion Valley in Irvine. What's it called? Fashion Island or something. The big fancy mall down in Irvine. He goes to these neighborhood strip malls anchored by a supermarket where there's no competition, and somebody gave him $400 million and said, okay, Stuart, go out and buy these in the crash. And he knew all the players because he's been doing this for 40 years. So he went, all these people, were underwater. They call him up. These things aren't even advertised. And he's taking them for the note that they owe the bank. He's taking them for, they just want to hand over the keys. And it's pretty hard to lose money when you invest at that point because people in neighborhoods don't have other shopping options are going to go to the supermarket. He fixes the parking lot, puts some trees up, puts a new coat of paint on, has escalator rents, fills up the empty spaces with anything, right? Not just nail salons, but or tattoo parlors. Just making a little joke there. But I can see the cash flows from that, and I can see the distressed real estate. That's one of my favorite areas because I can value the cash flows. Residential, it's just too local.
All right, well, thank you very much.
And we'll sign the books, by the way, anyone who wants us to.